That's a lot of room there, 21% just in the last month alone. And there's a lot of concern about a global slowdown, China not looking economically as healthy as it once was. What's behind this, and can it continue?
Well, I think two things to keep in perspective. First of all, if you go back, say, to the beginning of 2011, the rise in the Chinese market is less than half that of the S&P, so it really has a lot of catching up to do. Second, China is probably one of the biggest beneficiaries of lower oil prices. They import a lot of energy. They're probably the biggest oil importer in the world now. And so as oil prices come down and you look at winners and losers in the global economy, China's right up there at the forefront in terms of winners.
So Chinese people are going to have more money to spend as a result of lower oil prices that theoretically should boost some internal consumption?
The big economic question in China is how and when, because it has to happen, is demand going to shift from enormous investment, overinvestment, a lot of people believe, in infrastructure, largely funded locally by the municipalities, the provincial governments, to consumption. And this is a step. Clearly, the oil prices, it's like, as I said earlier, it's like a big tax cut on consumers. Second, there's something else going on, and frankly, I'd be interested in your point of view, which is these tentative, gradual, but it seems only one-way steps towards internationalizing the renminbi. So you've now got an integration between Shanghai and Hong Kong. Shanghai was way behind Hong Kong, but you now can trade stocks between the Shanghai shares and the Hong Kong shares, a whole new avenue for arbitrage. I don't know what that means for how directly that affects the Shanghai market. If you have a point of view, I'd love to learn.
Bill?
Yeah, I mean, I don't think it's a tremendous impact. These, as you said, these are baby steps that have been going on for quite some time in terms of liberalizing the capital account and capital flows in China. But I think the big question here is what happens with this newfound income flow in China. Do they spend it or do they not? And I think that's critical. You know, we had an article in the Wall Street Journal today about all the international agencies revising up their economic growth estimates for next year based on the oil price decline. One of the places we really have to see that is in consumption in China. They have to take advantage of these lower energy prices to begin to consume more. Frankly, if they put it all into stocks and they don't consume it, that's not necessarily good for the world economy.
Well, remember, if they're buying stocks, somebody's selling.
Let's hope.
So the fact is, the liquidity doesn't disappear.
Absolutely.
One of my, I guess, fundamental issues, though, with all of it is that I question whether or not you really can have a capitalist economy and therefore a real engine of growth without a democracy.
Well, you know, in the 19th century, you had it in England until the 1880s, in Germany until after the First World War. These were not democracies. These were autocratic governments, in many cases, in Germany, very autocratic, with enormous capitalist-driven economic development. The intersection of democracy and capitalism, of one person, one vote, $1, one vote, is a very, very modern phenomenon. And as we were talking about with funding American political campaigns, we're just still discovering what that means.
We talked earlier about, oil prices being as low as they are. Part of that is being affected, of course, by a stronger dollar. This is good news for American consumers because it means their money goes a little bit further, but there's a flip side going on here as well. And that's concern that everyone's debt, that if they hold, it's just going up, 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 up around the world, not including the U.S.
Well, the point is the debt, so much of the debt is denominated in dollars, debt that's been issued by borrowers that don't have dollar income. Now, this BIS report should be taken very seriously. Its author is one of the greatest financial economists in the world. His name is Hyun Shin, S-H-I-N. He went from Princeton to the BIS just about a year ago. And he has done detailed analysis. And by the way, he was one of the guys who got the global financial crisis right and got it right ahead of the game. He is an extraordinarily knowledgeable and accurate analyst.
Let's play this out. The idea is everybody who has dollar-denominated debt, who doesn't have income coming in dollars, is seeing their debt go up, 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 up. How does that then lead to a financial crisis?
Well, they have to generate, first of all, they have to pay the interest in dollars, right?
Right.
So they have to go buy dollars. What does that do to the dollar? Dollar's too high, pulls the dollar up higher. So there's demand for dollars that's driven by the issuers who, instead of selling dollars because it's too high, when a price goes up, that's supposed to increase supply and reduce demand. but here it's increasing demand.
Bob, how long might it take before something like this really starts to have some consequences? I mean, we can talk about it in the theoretical now, but what's the timetable?
You know, it really depends on the mismatch for different countries. You know, like you go back to Mexico in 1995, the crisis there, a lot of that, excuse me, a lot of that was brought on by not having enough dollars when the crisis hit. A lot of the dollar borrowing in recent years has been in China. But, you know, Chinese have a lot of dollars. They do take in a lot of dollar income, so that's not a problem. The Asian currency crisis was a bit of a mismatch with dollar borrowings, and at that time, interest rates went up, and it became more difficult to pay those back. So it's going to go country by country. I don't think in the aggregate we have the kind of problems and mismatches that are going to cause a financial crisis anytime soon. Some companies are going to borrow in dollars and not be able to generate enough revenue. You're going to have some earnings hits and the like. That's a bit more of a micro issue for me than it is a macro issue.
All right, we're out of time. Unfortunately, very interesting conversation.